Hello and welcome back. In our last lesson, we learned why adjusting entries are a critical part of the measurement process. We established that due to timing differences, the balances in our accounts at the end of the period don't always reflect the economic reality. Today, we move from theory to practice. We will roll up our sleeves and record the specific adjusting entries for one of the two major categories: prepayments. As a reminder, prepayments occur when a company pays or receives cash before an expense is incurred or a revenue is earned. We'll work through 4 specific examples from Eagle Soccer Academy, adjusting for prepaid rent, supplies, the depreciation of equipment, and deferred revenue. Let's start with prepaid rent. On the 1st of December, Eagle Soccer Academy paid $60,000 for 1 year of rent in advance. This created an asset called prepaid rent. By the 31st of December, 1 month of that rent has expired. We've used up $5,000 of the benefit, so we need an adjusting entry to reflect this. To do this, we need to recognize an expense and decrease the asset. Expenses increase with a debit, so we debit rent expense for $5,000. Assets decrease with a credit, so we credit prepaid rent for $5,000. Now for a common mistake. Students sometimes confuse the initial cash payment with the adjusting entry. Remember, the cash entry on the 1st of December created the asset. The adjusting entry on the 31st of December recognizes the expense that occurred after the cash flow. Next up is supplies. On the 6th of December, Eagle purchased $23,000 of supplies on account. At the end of December, account reveals that only $13,000 of supplies are left. This means the company must have used $10,000 worth of supplies during the month. We need to record this consumption. The adjusting entry is a debit to supplies expense for $10,000 to recognize the cost that was used, and a credit to the supplies account for $10,000 to reduce its balance to the correct amount. Our final prepaid expense is a special one for long-term assets like buildings and equipment. On the 1st of December, Eagle bought equipment for $120,000, which will be used for the next 5 years. We need to allocate the cost of this asset to expense over its useful life. This process is called depreciation. For December, 1 month of the equipment's use has expired, which is an expense of $2,000. So, we debit depreciation expense for $2,000. Now, you might expect us to credit the equipment account directly, but for depreciation, we use a special account. We credit a new account called accumulated depreciation for $2,000. Accumulated depreciation is a contra account. A contra account has a balance that is opposite or contra to that of its related account. Since equipment is an asset with a normal debit balance, accumulated depreciation is a contra asset with a normal credit balance. We use this to keep the original cost of the equipment on the books, while still reducing its net value. The equipment's original cost minus its accumulated depreciation is called its book value or carrying value. Now, let's look at the other type of prepayment, deferred revenues. This arises when a company receives cash before it provides the products or services. This creates a liability, an obligation to the customer. On the 23rd of December, Eagle received $6,000 from customers for future soccer lessons. This was recorded as a liability. Assume that, by the end of December, Eagle has provided lessons worth $2,000. We now need an adjusting entry to decrease our liability and recognize the revenue we've earned. To decrease our liability, we debit deferred revenue for $2,000. To recognize the revenue, we credit service revenue for $2,000. This reduces our liability to the remaining $4,000 and correctly reports the $2,000 we earned on the income statement. Let's quickly recap. We've now seen how to record the essential adjusting entries for prepayments, from using up rent and supplies, to depreciating long-term equipment, to earning revenue that was paid in advance. Each entry serves the same ultimate purpose: to get the right amount of expense or revenue onto the income statement for the period, and the right asset or liability balance onto the balance sheet.